I've had the police break down doors at my property twice. Yeah, not my proudest moment as an investor. But that's what happens when you buy the wrong type of property. I've been in the property game for years now, and trust me, I've made some shocking mistakes along the way. But I've also found some absolute winners that keep making money with barely any effort. So in this video, I'm going to show you the properties you should be buying right now and the ones you should avoid like the plague. To start, I'm going to go through the types of properties you absolutely should not buy, and more importantly, why. Now, this isn't to say that these properties are bad in every situation. Some investors make them work, but for most people, they're more trouble than they're worth. So, have you ever seen those deals that just seem too good to be true? You know the ones. Glossy brochures, fancy marketing videos, and a salesman who makes it sound like you'd be crazy not to invest. It all sounds incredible. But if a property is really that amazing, why do they need to push it so hard? The truth is, when multiple companies are aggressively pitching the same property, it usually means the developer is struggling to sell it through the normal channels. They're offering massive commissions to anyone who can offload these units. And guess who ultimately pays for those commissions? That's right, you do. At Property Hub, we buy more than £100 million worth of property every year, and we see all kinds of problematic properties that we reject later being punted around. I'm talking about off-plan developments that need a 25% deposit or more, or projects from developers with a questionable track record, or student accommodation with highly suspect guaranteed rents. You name it. And something being plastered all over the internet is just a bad sign in general. In fact, we're not even allowed to advertise our deals online because developers don't want most buyers to know that a select few are getting significantly better terms. When you have experience, you can spot these red flags a mile off. But if you're just starting out, here's a shortcut. Avoid anything being pushed too hard by salespeople. If the best thing about an investment is the sales pitch, that's your cue to walk away. Now let's talk about the second property type you shouldn't buy. It's the investment approach that promises higher yields than traditional buy-to-lets. And technically that's true. The gross income is definitely higher. But here's what those flashy presentations don't tell you. The costs are higher too. Much higher. You're looking at increased agent fees because managing multiple tenants is more work. The wear and tear is significantly greater because you've got more people using the same facilities. And don't get me started on the regulatory hoops you need to jump through. Licenses, safety certificates, constant inspections. When you honestly crunch the numbers, after accounting for all these extra costs and the additional time investment, the net returns aren't actually that much better than a standard rental, if at all. Plus, when you eventually want to sell, no homeowners are interested. So your buyer pool is limited to other investors only, which caps your potential for capital growth. In case you haven't figured it out already, I'm talking about HMOs, houses in multiple occupation. Now, I'm not saying that they're bad investments across the board. Some investors build their entire portfolios around them and do exceptionally well, but they're often marketed as the perfect solution for everyone, when in reality, they're only suitable for a small minority of investors who have the time, knowledge, and systems to manage them properly, and who are motivated by collecting rental income today, rather than owning assets that significantly grow over time. If you're just starting out, in my opinion, you're much better off with something simpler and learning the basics before considering an HMO down the line if it fits your goals. Now, remember when I said I've had the police break into my property? Well, I wasn't kidding. I've had the police break down the door of the same property twice at different times because of different tenants. This is what happens when you see a property listed for next to nothing, the rental yield looks insane, and you start thinking you've outsmarted the system. Why would anyone pay double for a house just a few miles away when this one does the same job for half the price? Well, here's why. These properties might look great in a spreadsheet, but in real life, they come with endless problems. I own properties that, on paper, deliver a 15% ROI, but in reality, that return disappears the moment you factor in the hidden costs. A simple £200 repair wipes out a month's profit. And as for the tenant profile, let's just say it's challenging, meaning higher chances of missed rent, evictions, and, in my case, police raids. And when you finally want to sell, no homeowners want it. And investors who know the area will lowball you because they understand exactly what they're buying into. And that's the problem with buying cheap houses in bad areas. So what's the solution? You don't need to start with a Rolls-Royce property, but don't go too far down market either. If prices in your area make it impossible to find a decent property, you're better off looking in a completely different part of the country. For perspective, £200,000 could get you a luxury apartment or a modern 3-bedroom house in some regions, whereas in London, it might only buy you a problematic studio flat or, in the best areas, a parking space. And that's why buying cheap houses in bad areas is almost always a losing strategy. So now you know what you should avoid, let's talk about where your money should actually go. I'm about to share my top 3 property investments that have consistently delivered results for both me and our clients. I'll start with my third favourite and work our way up to the absolute best property investment on my list right now. And just before we get into the list, if you're cash rich but time poor and you want to build your own property portfolio, we can help you find high quality properties and avoid bad ones. So if you want to talk through some of the deals we have available now, click the link in the description to book a call with a member of our team. Now onto our list. So this one isn't flashy. It won't impress your friends at dinner parties, and it's definitely not the type of investment you'll see in glossy brochures. But what it lacks in glamour, it makes up for in solid performance. These were actually my first few purchases when I started investing, and they've been remarkably reliable over the years. They tend to be extremely well built, and they yield really well because the purchase price is relatively low compared to the rent they can generate. The stability can be incredible too. I've had the same tenants in one of mine for 6 years, and in another one I had tenants stay for 10 years. That's a decade of consistent income with minimal hassle. The downside though is they're never going to skyrocket in value. There's always going to be a limited pool of buyers because they're not typically a home buyer's dream, and many investors skip over them too. I'm talking about quality ex-council flats. But notice I said quality. There's a big difference between a well-maintained ex-council property in a decent area versus just buying the cheapest one you can find. So when you're going for this, here's what to look for. Avoid high rises because lenders don't like them and they're harder to sell. Make sure there are no antisocial behaviour problems in the building or the immediate area. And never go for the absolute cheapest. Pay a bit more for something in a better location. It's not the most exciting investment in the world, but if you want something solid, reliable and easy to rent out, this is a great starting point. Moving up to my second favourite property investment, this one's for those who want to catch the wave when markets boom. When property prices start rising, these are some of the first to take off. They appeal to a wide range of people. Young professionals, small families, students, even retirees looking to downsize. That versatility is a massive advantage. You'll rarely struggle to find tenants. And when it's time to sell, you have a much bigger pool of buyers compared to more niche investments. But what makes these especially interesting right now is that they're priced lower relative to houses than they have been in years. This is mostly due to cladding concerns and the pandemic-driven race for space, both of which are resolving. And when that happens, they're likely to outperform. So what am I going on about? Quality city centre apartments. For example, we bought some in Manchester's Deansgate Square for our clients in 2019, and they've done phenomenally well. Huge capital growth, rising rents, and a steady stream of tenants. The only reason these don't make my number one spot is that tenancies tend to be shorter than with other property types. This creates more turnover, which means more hassle and additional costs. If you're going down this route, focus on quality. It's a recurring theme, but the best properties always perform better. Check lease length and ground rent. Newer builds are usually fine, but older ones can have issues. And look for scarcity value if you can. For example, a 3-bed apartment will normally have stronger demand than a 1-bed because they're far rarer. If you buy well, city centre apartments can deliver strong rental returns and serious capital growth. Finally, we've made it to my number one property investment pick. Just like ex-council flats, it's not the flashiest, and you probably won't see it being hyped up in investment seminars. But here's the thing, it works. This is the type of property where you buy it, put a family in, and let it quietly build wealth in the background. Rental demand is always strong. Capital growth benefits from the ripple effect of the nearby city. And best of all, it's low effort. So what is this magical property type? It's the humble commuter area house. We bought these in areas like Doncaster for our clients, and the demand is insane. The phone goes nuts every time one of these houses comes up for rent. And the best part is, we're getting brand new top spec 3-bedroom houses for under £200,000 in some of our target areas. For a nervous first time investor, it's an incredible entry point. Solid rental income, steady capital growth, and minimal hassle. But if you're going for this type of investment, here's what to keep in mind. Newer houses often work best. Less maintenance, fewer surprises. Victorian houses can get great capital growth, but they'll drain your wallet with maintenance costs along the way. Stick to strong commuter areas. close enough to a major city to benefit from its growth, but far enough out to be affordable. It won't make headlines or double in value overnight, but if you want a stress-free, high-demand rental with long-term growth potential, this is the one. So now you know exactly which properties to buy and which ones to avoid. But there's one more crucial piece of the puzzle. Location. After all, the perfect property in the wrong city could still be a mediocre investment at best. So check out this video next, where I reveal the 5 best cities to buy property in 2025, including one that most investors are completely overlooking.